What's going on? Alex here, and today we're going to talk about the S-corporation election. Now, I get asked about this all the time by business owners who feel that making the S-corp election is the holy grail of taxation. So as soon as they make it, the clouds are going to open up and tax savings are going to rain down on them till the end of time. Now, while there are some benefits to be associated with the S-corp election, which we're going to take a look at, there are also a lot of things to consider and keep in mind when you go through the decision-making process as to whether or not the S-corp election makes sense for you. So we're going to split this up into two different phases. The first one is going to be some general background, some things you need to keep in mind, some things to take into account before you make the election to make sure that it makes sense for you. And in the second part, we're actually going to take a look at some numbers and see how everything flows through from the business tax return all the way down to the individual return. So with that said, I want to make clear that this video is going to hone into some specific aspects of making the S-corp election. So we're not going to take into account, for example, whether it's a specified service, trade, or business for the QBID deduction. We're not going to take into account alternative minimum tax implications, the additional Medicare tax, and so forth. We're simply focusing on the Social Security and Medicare side of things on the S-corp side so that we can compare that apples to apples to just working as a sole proprietor and filing Schedule C. So what does it even mean to make the S-corporation election? So to understand that, we need to back up a little bit. I have business owners constantly asking me the following. They'll say, hey Alex, I'm thinking about starting a business. I want to form an S-corp. What's your advice? Now, right there, we need to back up and consider the following. When you form a business entity, that's a legal process that's handled at the state level. So at the state level, you could form an LLC, you could form a corporation, you could form an LLP, which is a limited liability partnership. You have a wide variety of entities to choose from, but S-corporation is not one of them. So you might say, well, how do I get taxed as one? So the first step is to actually form the entity at the state level, whether it's an LLC, LLP, corporation, and so forth. The second step is to decide how you want to be taxed. Now, the IRS gives you the flexibility to choose a different form of tax that's not necessarily reflective of the entity that you have in place. So, for example, you can have an LLC that you elect to be taxed as a C corporation, which is kind of weird because from a tax perspective, you're treated as a C corporation, but from a state and legal perspective, you're still an LLC. Likewise, you can also form a corporation at the state level, and the default treatment for a corporation is for that to be taxed as a C corporation for tax purposes. But you can also make the S corporation election and have your corporation taxed as an S corporation. Now, all that really means is that you're saying to the IRS and possibly the states that recognize the S-corporation election, you're saying, hey, I want to be taxed under subchapter S of the Internal Revenue Code. That's a specific set of rules where all of the S-corporation rules and regulations live. Well, most of them. So with that being said, you're basically telling the IRS, hey, I want these set of rules to apply to my business from a particular date moving forward. And basically the IRS has to approve that election, and once it's approved, you're all ready to go as an S-corporation. So to sum it up, it's important to understand that every entity has a default tax treatment from a tax perspective, and if you want to change that default tax treatment, then you would possibly make the S-corp election or be elected to be treated as a C corporation and so forth. So if you form a single member LLC, the default treatment is as a disregarded entity. So if you want that entity to be treated as an S corporation, you need to make the S-corp election. If you form a corporation at the state level, then again, the default treatment is that it's treated as a C corporation unless you make the S corporation election, and then it may be treated as an S corp. Now, if you just form a business and you're a single member LLC or a sole proprietor, you're dealing with Schedule C and Schedule SE, and you're essentially paying 15.3% in self-employment taxes. Not exactly, but that's kind of a rough figure. And the goal when you make the S corporation election is to reduce that as much as possible. Now, there definitely can be some tax benefits in this area, but there are important also landmines to avoid when you're considering making the S-corp election. And one of the really important factors to keep in mind is reasonable compensation. What's reasonable compensation? Well, here it is in a nutshell. So if you're self-employed, let's say you have $100,000 in net income, all of that flows through on the Schedule C, ends up on Schedule SE, and you're basically paying self-employment taxes on all of the net income. So that can add up pretty quickly. Now with the S corporation election, let's say you have $100,000 in net income for your S corporation before you pay yourself. there is some flexibility with regard to how you take money out of the S corporation. So you can't just write a check to yourself from the corporate bank account to your personal bank account. The allocation needs to be as follows. You need to have a certain aspect of your compensation be salary or wages, which are paid through payroll, meaning a W-2 that you issue from the S corporation to yourself. The other portion is the distribution portion. So that is the element of your compensation that you write a check from the S corporation to yourself. So there has to be an allocation. Let's say $100,000 is the net income of the S corporation and you want to take all that money out, then there needs to be some portion of that that's paid out through salary or payroll or W-2, whatever you want to call it. Then the rest of it can be distribution, which is a check that you write from the S corporation to yourself. Now you might be asking, okay, well, what's reasonable compensation? What's the amount? What's the magic number? Tell me. I would love to. And the quirk there is that the IRS has never officially defined reasonable compensation. So unfortunately, as much as the tax community would love to have a number to point to and say your reasonable compensation should be X, it doesn't exist. So it comes down to being a facts and circumstances analysis. Now, what does this even mean? This all sounds crazy. Reasonable comp, facts and circumstances. What's he talking about? Now, when you are considering the S corporation election, how it works, obviously, if you're a business owner, you're going to say, well, I have 100,000 net, I have 1,000 salary, and 99,000 distributions. We're done. We're good. It's over. Well, the problem there is that the IRS is most definitely going to audit you in that respect because they absolutely hate situations where business owners take this allocation of distributions versus salary and use it in a way that's not aligned with the reasonable compensation paradigm. So reasonable compensation is important to take into account. Now again, I mentioned it's facts and circumstances. What does that mean? Now, to figure out your reasonable compensation, let's say you're a doctor, you're a graphic designer, you're an attorney, what have you, you have to sit down and look at what you might have to pay someone else to do the same work that you're doing that has the same level of skill, same level of experience, same level of expertise, same level of education, and so forth. So it's a matter of taking into account basically paying somebody else to do the job that you do. There's also an additional amount that you'd have to add in for the management of the company. So the hours that you spend doing that and what the compensation should be for that aspect of things. And all of those aspects form your reasonable compensation. Now, if you're an individual that has a business with 100,000 net income and you make the S-corp election, it may very well be that reasonable compensation is very close to the amount that you're taking out of the company, being that 100,000. So you may be very close to the situation you were in before you made the election, in that before you were paying self-employment taxes, now you're having the S-corp pay half of your payroll taxes, you're paying half of your payroll taxes, and essentially you end up in sort of the same place. But now you have tax filing fees, administrative fees, accounting fees, and so forth. So that's where the S-corp election may be disadvantageous in those respects. Now, to sum it all up in a neat little package, reasonable compensation takes into account the following: the number of hours you put into a particular activity, the nature of the work that you're doing, your skills, your background, the amount that you might have to pay somebody else to do the same work, the amount that's the average compensation per hour in the area in which you live for the work that you're doing, and so forth. And on top of that, you need to add some amounts to account for the fact that you're also managing the entity, because you're the boss. So you make the decisions, and if someone else was making the decisions on your behalf, you'd have to compensate them accordingly. So to determine reasonable compensation, in many cases, it's important to actually put some numbers together, do some research, and come up with a reasonable compensation number. Now, the lazy approach that I see all the time is that a business owner will say, listen, 25% is distribution, 75% is salary, we're good. Well, that may work in a particular year because you got lucky, but that's not a great approach, because when your business goes from netting 100,000 to $1 million, you're not going to want that 75% figure to follow you all the way to that point. Now, if you start changing that 25% allocation as you go forward in time just to kind of suit your needs, you run the risk of not being able to justify or substantiate your reasonable compensation to the IRS if it's ever questioned. So the best approach is to determine what reasonable compensation is for you in a particular field, for the work that you do, and so forth, so that you don't have issues moving forward. And as you put in different amounts of hours in different years, you can adjust your reasonable compensation accordingly, because as your company grows, as you add employees, as you add equipment, as you add technology and so forth, it can be argued that the net income of the business is not solely being generated by your personal blood, sweat, and tears. There are other aspects at work, meaning the capital you put to work, the employees you put to work, and so forth. So in those cases, the net income of the business and the salary that you pay yourself, there may be a greater differential there and more of an opportunity to enjoy some tax savings from the S corporation election. But you need to make sure that reasonable compensation is taken into account each year. So let's go back to that example with the $100,000 of net income. Now, it may come out to $75,000 being a reasonable compensation, so that's going to be paid from the S corporation to you through the W-2, through payroll, through salary, wages, whatever you want to call it. And then the other $25,000, you basically write a check to yourself. Now, to be clear, you're still paying income taxes on the entire $100,000, but you're not paying Social Security and Medicare taxes on the $25,000 in distributions. You're solely paying the Social Security and Medicare taxes as the employer for the payroll, and then you're paying Social Security and Medicare taxes as an employee on the payroll, but you're not paying any Social Security taxes on the distribution portion. This is why the IRS is sensitive about this area, because this area is rife with abuse, and there have been many cases where, for example, a business owner who is the sole owner of the business will take $1 million in distributions and $20,000 in salary. That's not going to work, okay? So, if you're an individual and you have a business where you're the only shareholder employee and you're taking out $100,000 out of the business and you're making the case that $10,000 is reasonable compensation, you're going to have problems. Okay, it's very hard to justify that your reasonable compensation is that low if it's only your blood, sweat, and tears that's generating the income. So, with that said, to sum it all up, you need to determine reasonable compensation before you figure out what your year is going to look like, so that you don't have a disproportionate amount of distributions as compared to reasonable compensation. So, that is probably the area that's the biggest hurdle in making the election that I see, because in many cases, business owners have no idea what the reasonable compensation should be, so they're kind of lost in that area. So it's often beneficial to have a professional take a look at what reasonable compensation should be for you, so that it takes it out of your hands, it takes the risk out of your hands for the most part, being that it's a professional looking at it. Now, ultimately, at the end of the day, you're responsible for your own tax returns, so you do have to make sure that whatever work is being done on your behalf is reasonable and makes sense, and it's good to get a second opinion and so forth. But in general, it's really important to make sure reasonable compensation is taken out and taken into account, so you could start the payroll throughout the year and not bunch it all up on the last day when you determine, oh man, I made 60,000 distributions, I didn't pay myself any salary. It's way too common that happens. It's messy to clean it up. So what I'm advising you is definitely take reasonable comp seriously when you make the S-corp election, or you're considering making the S-corp election. You need to take that into account to see what the end result is going to be in terms of tax savings, if there are any. Another 3 important considerations with the S-corp election are penalties, penalties, and penalties. Now, when you have a single member LLC, let's say, and you're the only owner, you're reporting your income and expenses typically on Schedule C of Form 1040. At the end of the day, it's still a single tax return. If you make the S-corp election, however, now you're looking at filing the 1120S annually and also your personal income tax return. So it's 2 separate returns, and then you have K-1s that are going to flow through from the corporate return to your personal. Now, the penalty for non-filing of the S-corporation return in a timely manner is $200 per owner per month. So you can see that can add up fairly quickly. Now, on top of that, if you don't issue Schedules K-1 to the owners in a timely manner, you can also be assessed an additional $260 per month per owner that those Schedule K-1s aren't issued. So as you can see, the penalties can add up extremely quickly when you don't manage an S-corporation in the proper manner. So if you're someone who's disorganized, who doesn't keep track of deadlines, who leaves things till the last minute, that's something definitely to keep in mind prior to making the S-corp election, to make sure that you could cross your T's, dot your I's, and avoid the penalties. Now, another important consideration pertaining to the S-corp election has to do with the QBI, or the Qualified Business Income Deduction. So this was a deduction that was put forth by the Tax Cuts and Jobs Act, and essentially allows for a deduction of up to 20% of qualified business income, or QBI. Now, this deduction is extremely complex. It has a lot of twists and turns, but on a very basic level, if you're self-employed and let's say your net income is $100,000 versus if you have an S corporation and your net income is $100,000, the QBI deduction can work in very different ways. The reason being that when you have an S corporation election and you're paying yourself a salary, that salary portion is not includable in QBI. Now I know that sounds crazy, but it's going to make a lot more sense when we take a look at the numbers, and I'm going to show you the actual effect of that salary and how it impacts the QBI deduction. So I just wanted to mention that, form the baseline here, and then once we look at the numbers, this will make a lot more sense for you. Bow, bow, bow.